One of the biggest mistakes investors make is waiting until everyone agrees that a company is a winner. By that point, the easy money has often already been made. The biggest stock market winners rarely look obvious in the early stages. Instead, they usually face skepticism, execution risk, and questions about valuation or concerns about whether the business can even in fact continue growing. And in today's video, I want to discuss two stocks that I believe still have the potential to create tremendous amounts of long-term shareholder value. Now, that doesn't mean that they won't be volatile. It doesn't mean that they won't move in a straight line. But it is these businesses that continue executing over the next several years that I believe early investors could be rewarded in a very meaningful way. Not only do I want to own these stocks, but I also utilize option plays with them as well, which I will share with you today. And before I jump in, as always, if you could help me out and show your appreciation for the work I do in putting these videos out, just simply hit that like button down below. Subscribe to the channel. It helps a ton. So with that being said, let's jump right into the first company. And that first stock is going to be Celsius Holdings, stock ticker CELH. Now, Celsius has been a fascinating story in the consumer sector, going toe-to-toe with the likes of Monster. Over the past 5 years, it's been a bumpy ride for Celsius shareholders. At one point, they were up over 250% early in 2024. But now, over the past 5 years, settling down with a 35% gain, compared to Monster Energy, the main behemoth in that sector, which is up 115%. However, this is something I've talked about in recent videos, the stages that companies go through. It starts out as an idea, and the excitement around it pushes the stock price higher. But then as time goes on, results maybe don't speed up fast enough with expectations, and we see that excitement wane and the stock price get volatile and pull back. Over the past 12 months, shares of Celsius are down nearly 30%, and they currently sport a market cap of $8 billion, well short of the $95 billion market cap for that of Monster. Celsius, though, they've completely changed the way many consumers think about energy drinks. Rather than focusing purely on traditional energy beverages, Celsius has positioned themselves as a lifestyle and a fitness-oriented brand. That differentiation has helped it build an incredibly loyal customer base. Now, the stock has experienced periods of significant volatility, as we saw in the chart a second ago. Investors have questioned the growth strategy, inventory normalization, and whether the company's rapid expansion can in fact continue. Those concerns are understandable, but when I evaluate a business, I try to separate temporary challenges from long-term opportunities, and I still see several reasons to be optimistic when it comes to Celsius. The company does not report for another month, but here's a look at the latest earnings report. Revenue grew 138%, growing 140%, particularly in their biggest sector, which is North America. And international growth is still getting started. It contributed just $35 million, but that is up 55% from the prior year. But watching my videos for any amount of time, you know I don't just care about revenue growth. I want companies that can grow their top line while becoming more efficient at the same time. That is the high quality companies I'm consistently looking for. And speaking of that, let's take a look at margins. Looking here, you can see these profitability margins from Seeking Alpha, showing gross margins of 50% over the past 12 months. But what I like even more is EBITDA margins above 20%. And for Celsius, it currently sits just shy of 23%, which is up considerably over their 5-year average of just, say, 7%. This is a company not only growing top-line revenues, but doing it while becoming more efficient. And before we continue, let me take a moment to thank today's video sponsor, which is Seeking Alpha. I actually began my public investing journey writing on Seeking Alpha, and that has exploded into sharing it all with you here on YouTube. Seeking Alpha is a tool I started using over a decade ago and still utilize it today. Not only do you get great insights, but the data is fantastic. You see snapshots in my videos on a weekly basis. Seeking Alpha has a number of great subscriptions: Premium, Alpha Picks, and Pro. Personally, I use Alpha Picks as well as the premium subscriptions almost on a daily basis. But right now, as of July 7th, this is the final day of their summer sale that will get you 25% off when you use my link down in the description below. Give Seeking Alpha a try today. All right, let's get back to Celsius. And as I mentioned, international expansion remains in its early infancy stages to me. And second, distribution opportunities continue expanding as they have a big partnership with the likes of PepsiCo. Third, the energy market in itself continues to grow globally. Taking a look here at this chart, you could see as of the end of 2025, the energy drink market had an estimated market size of $86 billion. Fast forward to 2030, that is expected to reach nearly $130 billion. If management continues executing, I personally believe that Celsius has a much larger business ahead of it than the one that we see here today. The key risk, of course, is going to be execution. Growth expectations do in fact remain high, and competition is in fact intense. But that's also why I think long-term investors have the opportunity if the market becomes too focused on short-term results. Looking here at the earnings growth for the company, 500% earnings growth is expected this year, nearly 30% earnings growth next year. Folks, we are talking about a stock with those growth prospects trading at a forward earnings multiple of just 17 times. 17 times. That poses a huge opportunity. And for me, I've recently been utilizing options when it comes to Celsius. And here's a play I posted inside my investing community just last week that printed returns of 450%. And speaking of options, if you're brand new to options or you've been utilizing them for less than 5 years, let me tell you, options is what can take your investing to the next level. And on Thursday, July 9th, I will be hosting my final options workshop of the summer. This is my most popular workshop every year, and it sells out, so grab your spot. Thursday, July 9th, 7 p.m. Eastern Time. And even if you're unable to join us for the live portion, you will in fact get the replay. And anyone that enrolls, I'm also giving a free 14-day trial to my Options Edge community where you can see all of my option trades, when I enter them and when I exit them. I hope to see you Thursday. Check out the pinned comment to enroll down below. So when it comes to Celsius, what are some of the new trades I'm looking for? You could go out about a month and a half, call it, to August 21st expiration and look at the $25 strike, which would bring me in around $70 in premium per contract. Again, it's only a $33 stock. But if you want to be a little bit more aggressive and you like the stock, you could look at the $30 strike price, same expiration, and receive around $215 in premium, 3x that of the $25 strike. So again, it really depends on first, how much you like the stock and how aggressive you want to be. But regardless, this is a stock I believe has big upside. And analysts agree, giving the stock an average 12-month price target of $58 per share. That is good for 75% upside from current levels. Plenty of volatility, tons of upside. With that being said, now let's move on to stock number 2, which is going to be SoFi Technologies, stock ticker SOFI. I've talked about SoFi many times on my channel because I continue to believe the company is building something much bigger than what they're getting credit for today. Today, SoFi is becoming a full-service financial platform. Customers get access to banking, investing, lending, credit cards, financial planning, all within a single ecosystem. And that's exactly what makes this business so compelling. Every additional product increases customer engagement. Higher engagement often leads to higher lifetime customer value. That's a powerful business model, as not only is memberships growing, and when that happens, it allows them to cross-sell as well. Take a look here at this chart. You could see the membership growth, which has been massive over the past few years. And what also excites me is management continued focus on profitability while still investing heavily in growth. The market often underestimates companies that successfully transition from rapid growth to sustainable profitability. I think SoFi has the potential to do exactly that. Looking here at this chart, you could see the huge growth in revenues, but also adjusted earnings per share as well, both trending at a 30+% CAGR. Now, the stock certainly isn't without risk. There's loan performance, interest rates, competitive pressures. Those are all things investors should continue monitoring. But if management continues executing and memberships keep growing, I believe today's company could look dramatically different 5 years from now. Like was the case with Celsius, SoFi too is not really getting the credit for their earnings growth. The stock is trading at a forward earnings multiple of 22 times, while providing 53% EPS growth this year, followed by 35% earnings growth next year. Over the past 12 months, SoFi shares are down slightly, but what I'm seeing is a solid base that's being built around that $15 to $16 level, which is comforting as a shareholder. And if I were looking at a trade here when it comes to options for this stock, again, it's one I want to own, I would look at selling the $17 put expiring on August 21st, which would generate around $100 per contract. Again, this is only a $18 stock, which is a solid ROI, and I would do a number of contracts. So why do I like these companies? Why do both of them stand out to me? Because neither one has fully matured. They're still expanding. They're still gaining market share. They're still investing in future growth. That naturally creates volatility, but volatility isn't always a bad thing. Sometimes it's simply the price investors pay for owning companies with significant long-term potential. I don't invest looking for what a stock might do over the next 3 months. I'm asking a different question. What could these businesses look like 5 years from now? That's the perspective that excites me. One lesson I've learned over my years of investing: the market rewards patience. Some of the greatest investments in history spent years being doubted, but before becoming household names. Now, I'm not saying Celsius or SoFi will become the next Amazon or Apple. No one knows that. But I do believe investors who identify exceptional businesses before they become obvious often have the greatest opportunity to build wealth. That's why I spend far more time studying the business rather than worrying about next week's share price. At the end of the day, investing isn't about finding perfection. It's about finding businesses with improving fundamentals, large market opportunities, and management teams capable of executing over the long run. For me, Celsius and SoFi continue checking many of those boxes. Will they experience volatility? Absolutely. Will there be setbacks? Almost certainly. But these are companies with big upside. By the end of the year, I could see Celsius over $50 a share. I could see SoFi over $22 per share. Some may say I'm crazy. That's just me. I call it like I see it. And as always, if you like these videos, show your appreciation by smashing that like button down below. Again, it helps more than you know. And I want to see a comment from you down there. Which of these two stocks do you like best? Thanks again for watching, and don't forget about the options workshop on Thursday, July 9th, 7 p.m. Eastern Time. Can't wait to see you there. Take care.